Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. This is The Talking Point. It's Monday morning, June 12th, and this is an extremely busy week for the market. Now, last week, we didn't have any Federal Reserve speak. I say speak as we say Fed speak, but speakers. It is the blackout period where the Federal Reserve does not speak a week before their meeting. And, for the market, it's actually a relief because we had to listen to one Federal Reserve speaker after another. However, we were given a clue as to what the Fed is going to do and not do this week. And I'm going to talk about that in a minute. But last week, the S&P 500 moved into bull market territory. Technically, 20% off the lows, right? 20% off the lows. Now, already it is being analyzed and reanalyzed as to, wait a minute, is this really a bull market? Even though really just a handful of stocks led the market higher? How could that be? We could also argue that when the market basically did not go into bear market territory, when it did, it was just based on the large cap names trending lower, down 20% from the high. Back then, the analysis was, hey, wait a minute, much of the S&P 500 was already in a bear market for months and months and months. Why is it suddenly a bear market when only what we call the generals, right? It's always the stocks that are leading the market higher or lower when they start moving. Well, it is what it is. You wait for that 20%. Technically, that is the beginning of a bull market. That is the beginning of a bear market. So also, the S&P 500 actually crossed some important levels. As we wait for the market open this morning, it already looks like it's going to stay above 4,300, which was a key level. Even 4,200 was a key level that the market had to fight for and then fight to climb above S&P and move above 4,300. So what will be important this week is how the market responds to data, how the market responds, of course, to the Federal Reserve statement and the press conference. And it's going to be quite important for not just our market, but global markets where, currencies are involved. If the Federal Reserve actually skips or uses the word for whatever, but suggests that, hey, we don't really see, rate hikes coming in even at the next meeting. If it's what we call a dovish skip, right, as opposed to a hawkish skip or hawkish pause, the U.S. dollar could weaken or climb higher as a result. The more hawkish the Fed sounds, the more the dollar is going to rise against other currencies as the market believes the Fed is not finished with its rate hike campaign, even if that means just one more rate hike in July or perhaps another one after that. So there's a lot for the market to digest. Also, I want to point out that there is always much concern that the leadership in pushing the market higher was actually very narrow. So it was important for the market to see that the Russell 2000 was also participating in the ascent in the overall market. Now, then what happened was the Russell 2000 went very quickly into what we call overbought territory, meaning that its climb higher was very quick, but it pushed the valuations into and the amount of the move higher into, again, what we call overbought territory. It means that they have to digest those gains. Similarly, we will probably, if the market continues to climb higher now with the S&P 500, the broader market, and of course NASDAQ, at some point we will enter overbought territory as well. Now, markets can continue to move higher and higher or lower and lower in oversold or overbought territory, but normally the average is that markets need to digest gains or work off, losses, and that's the oversold territory. So we'll see how the market reacts, all the markets react to the Federal Reserve meeting. Now, in addition to all of this, I want to point out that the Atlanta Fed now, GDP, has the second quarter GDP at 2.2%, which certainly is not stellar, but it is by no means recessionary. They will come out with a new report. It will digest some of the economic data releases this week, and we'll see where it is. Remember, it's a fluid barometer of GDP because it changes as the new data are released. So that's going to be important for the market. Also, you probably remember that the market was concerned about a jump in the initial unemployment claims last Friday. When we look at those numbers, you also have to factor in that it can be skewed by a holiday week, but even so, counting that, it did look as if we saw a jump. Now, that said, the continuing claims actually was just, normal. There was nothing sharp in that reading. This week, I think it's going to be important because it's not a holiday, but we'll see whether or not those higher initial unemployment claims are suggesting a bit more pain in the labor market. So we don't take one data release and say this is the trend. We try to wait for a number of other readings to see whether or not it was a one-off or whether it was a trend. So again, keep in mind that on Friday, we're going to be paying attention to the initial unemployment claims and also the continuing claims. So to this week, the market right now is not expecting a rate hike on the June 14th. Keep in mind that on the morning of June 13th, the Fed will see the Consumer Price Index report. And remember, June 14th is when the announcement comes for the rate hike. And then on the 14th, the PPI, the Producer Price Index, will come out. These are important reads on inflation. The expectations are that we may just see a little bit higher for the Consumer Price Index. But overall, the expectations are, even if that were to happen, the Fed is not going to surprise the market with a rate hike, that they are prepared to wait. Why would they wait? Simply because also, the Treasury Department has to begin replenishing its general account. It had to basically, put on a shelf the ability to go out and raise money in the markets during the negotiations, the debt negotiations, and now it needs to start that. There have been, a back and forth of a debate within the market as to whether or not this could cause dislocations in the banks or in financial markets as a whole. And so the Federal Reserve most likely is saying, look, we can wait. We want to see how this goes. We'll monitor the situation and we'll be ready. It's interesting because many believe that the dislocation, and it isn't just this week with the Fed, the Treasury putting Treasury notes up to auction, but over the next number of months, that I've seen a tsunami of debt coming to market. But again, the Fed understands this, and I think that most traders believe that if there is a dislocation somewhere, the Fed could provide liquidity in the market right away. It's not as if they're going to be oblivious to it. They're going to be monitoring it. So again, I think the Fed wants to just hold off, see how markets are doing, and also see how the banks are reacting. Given that there has been so much concern over how the banks have performed, with concerns not over just the deposits leaving, but also in terms of their ability to take care of some of the commercial loans and commercial real estate loans that they hold. Regional banks hold the majority of those. So again, the Fed perhaps wants to assess all of this going into what the market expects is a rate hike in the July. It comes at the end of July, the July meeting. So If, and I want to point this out, if for whatever reason the Fed believes it needs to raise rates at this meeting, most likely they will inform the media that that's going to happen. The Fed, again, Chairman Powell has been very clear about this. They do not want to surprise markets when they are raising rates. That he has said in many speeches he believes it's important to notify markets as best they can so that small business owners, for example, consumers can make plans. Now, granted, we're practically there to the Fed meeting, and that suggests to us that the Fed is not going to come in still in their blackout period and change what the market believes right now, which is that there will not be a rate hike on the 14th. So we have a bit of important information coming out this week beyond just that will affect the Fed, which again is the CPI, Consumer Price Index, and the PPI, the Producer Price Index. We're going to have this week retail sales, which will be important, obviously, because at the end of the day, what is keeping this market actually holding up is that consumers are still spending. Granted, consumers appear to be more deliberate in their spending. They are using credit cards more. We're seeing a little bit of a slowdown in payments, but nonetheless, as long as the labor market remains solid, consumers feel comfortable continuing to spend. Normally, when the labor market slows down materially, when the unemployment rate climbs, to the point that it's making headlines. Right now it is at 3.7%. But if it were to cross above 4% and move dramatically higher, you tend to see consumers even more deliberate and holding back. So far, we're not there, but we will be watching very carefully what the higher interest rates are how they are affecting overall consumer spending on big ticket items such as automobiles. Also, this week, in addition to retail sales, we are going to have industrial production on Thursday. Obviously, that's after the Fed meeting. And then on Friday, a very important report coming out of the University of Michigan Consumer Sentiment Survey. Whether the consumers are happier or not happier, the one that the Fed pays very close attention to, and obviously right now they don't know what it is, it's coming out on Friday, but it has to do with the perception of inflation. And this is extremely important because once consumers begin to accept inflation as the norm over 1 year, 3 years, and 5 years, it becomes entrenched. It becomes the psychology of inflation. And this had climbed higher. It pulled back, and now we want to see whether or not consumers have a more realistic assessment of where inflation is headed. The Fed does not want to see it climbing higher because that means that consumers are saying, well, this is what it is, and then it leads to buy it today because tomorrow it could be more expensive. And why is this important right now? The reason is there is a perception that consumers, as long as we have jobs, are almost willing to pay the higher prices from the consumer goods part of the economy, also housing that is now turning the corner, and also in terms of tickets to travel, and dare I say, I won't mention it, but concert tickets, which are very expensive. We're willing to pay these higher prices. And the more we're willing to do it, the more, in essence, it's becoming entrenched. So that, in other words, inflation picking up from the demand side of the economy. This is something the Fed does not want to see. So it's going to be important again. On Friday morning, what are consumers saying about our longer-term inflation expectations? Also this week, we are going to hear from Lennar, one of the big developers, housing developers. The housing market stocks are doing well. The home builders are doing well. We want to hear what Lennar has to say in their report and also their guidance. Very, very important for the market, given that we've seen a turn in the housing market. Oracle will also report, and one of the things we like about the Oracle report is what do they see businesses doing. They offer a very interesting overview of how business spending in technology is faring. So the market pays attention to that overview. So we'll hear from them. Also, in terms of this week, I want to point out, as the market has been advancing, the S&P 500's 5-year average, right? 5-year average, looking ahead, is actually at about 18.6 times forward earnings. Right now, the S&P 500, according to FactSet, is 18.5 times forward earnings. This is up from just 18 times forward earnings just 1 week ago. The advance in the market actually has the S&P 500 trading at 18.5 times forward earnings versus 18 times forward earnings just 1 week ago. So it has moved up quite markedly. Now, 5-year average, again, is 18.6 times forward earnings, while the 10-year average is at 17.3 times forward earnings. This is important because already there is a tug of war in the market saying, wait a minute, this market is priced for perfection. It's priced for everything going well. There you go. I just want to point that out. And I also want to point out that when we look back over the averages over 10 years or even 15 years, we have to remember that there were times that the market had tremendous liquidity, and so the market could climb higher and higher simply because the liquidity in the market allowed it, and lower interest rates allowed it. And remember, we went through a period where rates were practically at 1%, and if we added inflation, at almost negative rates. So this is important to factor in. So as this market climbs higher, remember a couple of things. One, we're waiting to hear what the Fed is going to say. Two, we are also going to see the ascent in the S&P 500, but the market will reach a wall of being overbought. To repeat, overbought markets can keep going, but normally they will stop and they will digest those earnings. We'll see if that happens. We believe that happened with the Russell 2000, basically taking that push higher and digesting it. So there's a lot for the market to absorb this week, but let me just make it real clear. This is about the Fed, and it's about the Fed's message, and it's about the message really for the July 26th meeting. Thank you all so much. Have a very good week.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed. guaranteed, not bank or credit union deposits or obligations, and may lose value.